let's talk about how you can get better returns in a smaller period of time than a day trader. And that's without having the daily roller coaster of being a day trader. So a passive real estate investor investing passively into a real estate syndication, multifamily deal, or something similar to that have distinct advantages that I'm going to outline here over a day trader. In my 3 years at Charles Schwab, I talked to hundreds of day traders, saw their accounts, and had conversations with them. And what I will tell you is real estate investors, specifically passive real estate investors, do have a lot of distinct advantages over day traders. And I'm going to go ahead and outline those for you. First advantage is time. Day trading is a full-time job. Investing in a multifamily project should be little to no time. And what I mean by that is the most amount of time, in my opinion, should be actually vetting out people like me, multifamily syndicator, operator, the one that's actually finding you the deal and giving you the return that you get. There will also be time spent reviewing quarterly write-ups and some paperwork in the beginning to get started, but outside of that, there really shouldn't be too much day-to-day monitoring, or you're probably not doing it right. Day traders on a daily basis are looking at trends, they're looking at graphs, they're looking at the news, trying to interpret whether it's true or not. They are looking at earnings and quarterly reports from Fortune 500 companies that may not have the transparency that you would hope to make a decision like that. And a lot of it's just based on feel. And I know every trader has a little bit of a different strategy, but in the end, this is something that takes time, and it's a craft that a lot of people enjoy, but in the end, take a lot of time. Advantage number 2, when I was working at Schwab, I consulted hundreds, if not thousands, of traders. And what I will say is most of the accounts that I saw were in the red. Some of them were in the green, but most were in the red. And what that means is they've lost money. And I'm not talking that this is like someone that trades 50 times a year. This is someone that trades thousands, if not tens of thousands times every single year. This is back when Schwab actually charged almost $9 for a single trade. So you do the math on that and get back to me. There was always that outlier that was doing really well and trading really well on their account and knew what they were doing. Wasn't getting emotional, all that good stuff. I'm not here to talk about trading, but what I will say is you can do pretty well trading. I'd say based on the Google search and the research that I've done, you can make close to 200,000, maybe more than that if you're in the top 10% of day traders. That's pretty good. And then, you're taxed at somewhere between 10 and maybe 37% ordinary income on every single trade that you do. So positive, negative. Obviously, there are ways to offset your income with losses from previous years or losses in your account or other accounts. I'm not a tax accountant, but I know there are certainly tax strategies that traders use to get ahead and make sure that they're reducing their taxable gains. But passive real estate investing provides an opportunity to reduce or eliminate taxes based on the depreciation and naturally occurring event that is legal, and you don't have to actually go out and make a bad trade or buy a bad property to get that tax benefit. And if you own other income producing properties, then you could maybe reduce your taxable income on that property as well through cost segregation. Now, before I move on to a few tips, if you want to learn about a few different loopholes that investors are taking advantage of and that real estate investing offers, I want you to look in the description box or the comment section. The link to a free training that we created is in there. I think it's like 22 minutes. And basically it goes into how to earn 16% annualized returns without fixing toilets or managing contractors. This is a really great way to not only make the 16 to 18% annually, but also to be taking advantage of loopholes to make you wealthy. So go ahead and look in the description, and then also in the comments if you can't find it in the description, and we will see you there. Tip number 1, vet the operators. You want to make sure that the people, the general partners that are running this operation, the people that are actually finding the deal and running it from day one, collecting your cash, dealing with lawyers to make sure that they can get all of the right operating agreements drawn up, people that have the right partners that have experience in this world. There's just a lot of characters out there that aren't necessarily transparent and may not be running the best operations. So I really think that that should be the most amount of time that you spend, is finding someone that you groove with, someone that you can really get along with, but also trust, obviously. Tip number 2, there's always going to be some sort of minimum investment on these projects. If we're talking about a deal that's maybe in like the $5 to $10 million purchase price, we're probably going to be looking at $100,000 to $200,000 minimum investment. If it's a smaller project, you could see $75,000 or maybe even $50,000 minimum investment, but typically you're not going to see less than that if you're dealing with a syndication. So multifamily projects can range in size, obviously, and operators can do whatever they want. So if they want to bring in a bunch of people at $20,000, they absolutely can. But what I'll tell you is you probably won't find too many deals out there like that. So I guess if that's you have $20,000, you have a few choices. You could go day trade it, or you can save up and wait until you have that minimum investment to get into a deal like that. Tip number 3. I just want to make sure that you understand that this is something that has a maybe 2 to 7, maybe even 10-year commitment on. It's really going to be dependent on the deal that you are currently entering into. Now, market conditions and other things on the back end, like interest rates, we're experiencing that right now, can definitely impact how you disposition or sell the deal or even refinance a deal. So when you get into the property, just understand and expect that things can change. Obviously, there's going to be a game plan and A, B, C. If this happens, then we'll do this type of thing. But I think it's important for me to point out that if I were going into a passive investment, I would definitely want to expect that my money's going to be in there a little longer than maybe the operator says. And I don't want to say that it's always going to happen, but it is something that you want to keep on your radar and just make sure you're aware that it doesn't guarantee that you get your money back at a certain time. Tip number 4, this is not a get-rich-quick scheme. I know a lot of people out there have made a ton of money in real estate, in stocks, and in cryptocurrency over the last decade. There's been a crazy run-up. The government's been printing money, as we know, and it's just been a little bit crazy out there. The real estate market has probably made a lot of millionaires since the 2008-2009 crisis, and the stock market has gone absolutely bonkers. So I think it's a good thing, right? If you sold and you have some money in your pocket, but just understand that if you won in that environment, that it's definitely not going to be indicative that you're going to win an environment that we are in and going to continue in for quite some time here. So make sure that you understand that this is not play money. This is not something that you're going to be able to double or triple in a few years. This is something that is going to, along with the tax benefits that we talked about, get you in a spot that's creating long-term valuable wealth for you and generations to come, hopefully. Number 5, know what you're signing up for. When you get into a limited partnership or a passive investment in real estate syndication, you really do need to understand that you take a back seat once you get into the deal. And what that means is the general partnership, this is something that they do every single day. They have the resources and they have the team to perform and operate on a high level and get the property stabilized and to the point where they can disposition it or refinance it or whatever the plan is. So it's really important that they're bringing on people that not only can be amiable and trustworthy, but also can just take a back seat once they are in the deal and have vetted out the operators and have specific trust in the deal itself. So a lot of operators will actually be vetting the investors, not only to make sure that they're on board and have sufficient accreditation, but the fact that they're going to be able to be a good partner. And that's really important to a lot of operators. Now, at this point in the video, you're probably wondering, how is a return on investment or internal rate of return calculated? And why does it differ so much amongst operators? Now, my brother Austin recorded a video, and I would recommend as a next step to watch that one. And it's really all about internal rate of return, how operators may be able to skew it or leave out certain parts of that equation to skew it in their favor. So go ahead and watch that video and look forward to seeing you on the next one.